Good day, everyone. I am Shiela Mae and today we are going to analyze the financial statement of Century Properties Group Incorporated from periods 2020 to 2021. But before we start, let us know a little background of the company. So, Century Properties Group Incorporated has more than 3 decades of experience in real estate development, real estate marketing, and property development in the Philippines. It has a combined portfolio of 47 buildings as of December 31, 2019. And it is established in 1986 by CPG Executive Chairman Jose E.B. Antonio 6 days before the EDSA People Power Revolution. CPG has grown to become one of the top 10 real estate firms in the Philippines. The company's pioneering real estate concepts and industry firsts have resulted in some of the most exciting and truly remarkable real estate projects in the country, and have garnered both local and international praise and recognition, redefining Philippine real estate and setting the bar high in terms of architecture, design, amenities, and community living. So now let me show you the financial statement of Century Properties Group Incorporated. So I will now present to you the financial statement of Century Properties Group Incorporated from periods 2020 to 2021. And here is now the income statement. So let us first compute the liquidity ratio on the year 2021. So we use the formula of current ratio, which is current assets divided by current liabilities. So we can see the current assets of Century Properties Group Incorporated as of 2021 is 34,6,943,185. Divide it by the current liabilities, which is 14,183,254,919. So it is equal to 0.99 times. And then for the year 2020, so it is equal to 2.1 times. So let's analyze first the 2021 current ratio. So the 2021 current ratio is 0.99 times. So meaning it can easily settle each peso on the loan or accounts payable once. And then as of 2022, the current ratio is 2.1 times. So meaning it can easily settle each peso on loan or accounts payable twice. So a rate of more than one suggests that financial well-being for the company. The next one is the leverage ratio. So we use debt ratio. So first, in the year 2021, the debt ratio formula is debt ratio is equal to total liabilities divided by total assets. So 31,877,629,760 is divided by 53,008,903,420 is equal to 60%, while on 2020 is equal to 63%. So see, there is 3% difference. A debt ratio greater than 1 tells you that a company has more debt than assets. Meanwhile, a debt ratio less than 1 1% indicates that a company has more assets than debt. So in this case, we must see that the company has more assets than debt because it is not greater than 1 or 100%. So we can see that the company has more assets than its debt. Next is the asset turnover ratio, and its formula is net sales revenue divided by average total assets. We should base the financial statement, which is the balance sheet, and getting the net sales revenue and the average total assets. So, in getting the net sales revenue, I added 10,835,744,692 plus 14,315,016,268. It resulted to 25,115,760,960. And in getting the average total assets, I added 53,008,903,420 plus 53,441,685,612 and divided by 2. So it resulted to 53,225,294,516. So we divide it, so the result is 0.47. It means that a company is not using the assets efficiently because a higher ratio indicates that the company is efficient in generating sales or revenues. So since it is a lower ratio, it it greatly illustrates that the company is not using the assets efficiently. So let us now proceed to the profitability ratio, which I use the formula return on assets ratio is equal to net income divided by average assets. So let us now compute the return on assets ratio for the year 2021. So the net income is 795,555,66 divided by 53,225,294,516. So it resulted to 0.149 or 0.49%. So in getting the percentage, we must move two places to the right to get the 1.49. So on the other side, for the year 2020, resulted to 2.41. So this means that the profitability ratio is, so this means that for every peso of assets the company invests in, it returns 1 centavo in net profit per year. So the so this means that the return on assets ratio for the year 2021 is 1.49. So the return is 1.49 centavo in net profit per year, while on the year 2020, 2.41 centavo returned as a net profit per year. So lastly, we compute the market value ratio for the year 2021. The book value per share ratio is 1.81, while for the year 2020, the book value per share ratio is 1.68. So this represents the minimum value of a company's equity and measures the book's value of a firm on a per share basis. So under 1.0, it often indicates a good value. Value investors often use a PB of 3.0 as a good threshold. So PB ratio means price to book ratio. So if book value is higher than market value, it suggests an undervalued stock. If the book value is lower, it can mean an overvalued stock. So book value and market value are best used in tandem when making investment decisions, since it is highly useful for investors to get a real-world view of a company's equity value. So why should we focus about gross profit? Because gross profit is an important indicator for companies. This is because it increases the amount that is available to cover expenses. Also, the amount that allows profit to be generated for the owners. If it's too low, the company weren't profitable. Must analyze the financial ratio and its balance sheet and the income statement before investing a certain company, if it is good to invest in, if it is profitable. I guess that's all for my analysis of the financial statements of Century Properties Group Incorporated from periods 2020 to 2021. Thank you for listening.